Hello everyone, Tim Dorman here, founder of Eagle Ridge Wealth Advisors, and today I'm going to cover the three main types of investment accounts and the corresponding tax implications of inheriting each separate type of account. First, we usually have our tax-deferred accounts like our 401ks, our traditional IRAs, our 403bs, anything like that that is tax-deferred. And then second, we have our taxable accounts, which are going to be stuff like our individual accounts or our joint accounts. Basically anything that if you sell something and you have a gain or loss, then that's going to create a taxable event. And then of course, third, we have our Roth IRAs, which are our best accounts because if they are qualified, they are after-tax money, and any growth that we get in these types of accounts is going to grow tax-free and come out tax-free, right? So of course, we love Roths at my firm. Now, sometimes there might be reasons that we might not have a Roth, but generally, if we can get money into a Roth account, that's going to be a good thing, whether it's a contribution or a conversion. So of course, that's what we want to try to do. What happens if we buy a stock in a tax-deferred account or plan like a traditional IRA or 401k? Well, when we take that money out, it's going to be taxed at our own income tax rates because we haven't paid income tax on it. And of course, Uncle Sam is going to want his share of that money. We're going to get taxed on whatever rate we are at in the year that we take that money out. And it's going to be taxed at our 7-bracket ordinary income tax rates. Now remember, our 7-bracket or 7-bucket system is what our regular ordinary income is going to be taxed at. And right now, those rates go from 10% all the way up to 37%. And of course, it's marginal. So that means that you are only going to pay the rate on the income that your actual bracket falls in. So if you are in the 12% bracket and you make an extra $1,000 that goes into the 22% bracket, only that extra $1,000 is going to be taxed at that 22% rate. And any amount below that is going to be taxed in that respective bracket below it. Now, we also have a 3-bracket qualified dividends and long-term capital gains rates. And these rates are preferred to our 7-bracket ordinary income tax rates because of course they're quite a bit lower. And here the brackets are going to be 0 bracket, so obviously that's good. And then a 15% bracket, and then it tops out at a 20% bracket. And that doesn't kick into a really high income. So as I mentioned, they are much preferred to our 7-bracket ordinary income tax rates that, as I mentioned, go from 10 to 37. Now, let's say that we buy a stock in a taxable account like a joint or an individual brokerage account. Well, if we hold it for over a year, then it's going to be taxed at the preferable 3-bracket system of long-term capital gains and qualified dividends rates, which of course, as I just mentioned, are preferred, right? And of course, if we buy something in a Roth account, it's going to come out tax-free at the end because we have already paid tax on that money. And the great thing about a Roth account is that if it grows a lot, it's going to come out tax-free. So obviously that's a good thing, right? And of course, that's why most people like Roth accounts and try to get as much money into them as we can. Okay, now that I've covered the tax implications of each type of account, let's discuss what happens when these different account types are inherited. So first, pre-tax money. If you are a beneficiary and you've inherited a pre-tax account, like a traditional IRA, whenever you take that money out of that account, it's going to be taxed at your ordinary income tax rates, just like it would have happened to the original owner had they taken any money out. But now, of course, it's going to be taxed at your income tax rates and not the original owner's rates. And unfortunately, the Secure Act did away with the stretch IRA. And of course, this is very frustrating because what happens now statistically is, let's say that your parents have built up a nice pre-tax account and then they passed away and now it goes to you or, whomever the beneficiaries are. Well, it's going to go to them statistically when you're going to be in your 50s and 60s in your highest earning or peak earning years. So now you have to take that pre-tax money out of that account, and that's going to stack on top of your income in your highest earning years. Pretty annoying, right? And of course, now that we have the 10-year rule, you have to take that money out within 10 years. And that, of course, is going to create a bit of a tax bomb for you because the Secure Act says you have to take all that money out within 10 years. The Stretch IRA used to let beneficiaries inherit and then extend over their own lifetime how much their required minimum distributions were going to be. Now you are going to be required to pull all of that money out within 10 years. Again, typically in your peak earning years. Bummer. And this, of course, is a sneaky way for Uncle Sam to get more of your inheritance. And it can end up really creating a tax bomb for you as the beneficiary. Now next, what happens in a taxable joint or individual brokerage account? Well, this is actually pretty good. So let's say that your parents had a stock and they bought it at $10, and then of course over time it went to $100, and it's been in their taxable account. Well, God forbid they pass away, but they still own that stock. Now it's going to be left to you as the beneficiary, but it's going to be just like you purchased that stock at 100, and that's called step up in basis. And of course, step up in basis is obviously a good thing for beneficiaries, at least in terms of lowering taxes. Now, in certain situations, if we know somebody is terminally ill or probably not going to last that much longer, we can do some tax planning around that because of the step up in basis. Now, I know nobody likes to talk about this type of thing because nobody likes to consider their own mortality, but there are tax planning opportunities if you want to reduce lifetime taxes for your legacy. So like I said, if that stock was bought at $10 and it goes to $100 and your parents or benefactor passes away, then it would be as if you purchased that stock at $100, and you could sell it the next day at $100 and not pay any tax on that money. And again, that is called step up in basis. Now, what happens if you have the money in a Roth IRA? Well, if it's qualified Roth, it's a tax-free account, and that money is going to come to you, and it still have to come out within 10 years because of the Secure Act, and it's still an IRA, but the tax has already been paid on it, so it doesn't create a tax bomb. And as mentioned, Roths are the most beneficial account, and you're going to want to leave that money in there as long as you can if you are a recipient of an inherited Roth IRA, because it's still a Roth account and it's going to grow tax-free. So that's a wrap on the effects of inheriting the three different account types: traditional IRAs, Roth IRAs, and taxable accounts. And of course, how step up in basis works if you inherit any money in an ordinary taxable brokerage account. So thanks for tuning in, and I'll catch you in the next video. Once again, Tim Dorman here, founder of Eagle Ridge Wealth Advisors. And if you would like to see how we help our clients get the most out of their financial lives in retirement, please visit us at erwealth.com, and we hope to see you there.